Laugh when you borrow, cry when you pay. The quote attributed to people borrowing money. And today's topic, today's theme on the I Hate Numbers broadcast, if I can get my names right, is about borrowing money. When should you do it? Why should you do it? How should you do it? And I'm going to be talking about crap loans in a few moments. So, morning, folks. Hope your Friday is going well. Hope the week of lockdown is proving positive for you. The world is opening up again. And loans, borrowings have pretty much been a staple conversation over the last 12 months, certainly. And I'd like to share some thoughts with you today about what we should do when it comes to businesses borrowing money. Now, we've all got different attitudes to debt, which I'm going to explore in this 25 minutes broadcast. If you've got any questions and answers, by all means, throw them in. For those of you who may not be familiar with who I am, which is probably going to be one or two, my name is Hamood. I own an accounting firm, I have done for the last 26 years. I own a training company as well. So I come from a life of working in industry across lots of different sectors. I jumped ship about 26 plus years ago to start my own businesses. And I've been very fortunate in my business life to help businesses of various sizes, from acorn-sized businesses to sort of more mighty oak type businesses across the different sectors. I've been fortunate enough to work overseas, nationally, as well as regionally as well. I also had a spell in teaching for about 3 years. So with that in mind, my sort of DNA is consisted of helping people, helping businesses, obviously making money, saving time, and all that jazz. So why are we talking about debt? Now, before we go through the presentation, the slides, just to share some thoughts with you, just bear this in mind. All of us in business borrow money. We might not think we're borrowing money, but we actually do. So if we issue invoices to our customers and we give customers time to pay their bills, we're basically lending them money. Conversely, the other way around, when suppliers give us credit, they're lending us money. If there's any time delay between wanting something to use in your business, a resource, so whether it's staff that you've got, freelancers that you're engaging, materials that you're procuring, if you don't pay cash flow straight away, you're effectively borrowing money from that supplier, from that freelancer, from that member of staff to give you that resource that you need to power your business, to run your business, and for your business to grow. So the idea of borrowing money is not a complete anathema to us in business, but what we're specifically going to be talking about today is the idea of loans. And they're a slightly different beast, a slightly different animal. If you're coming up on replay, if you're not managing to join in on this live broadcast, thank you for your company anyhow. If you put in hashtag replay, I know you're out there. Any questions that you've got in the context of what we're talking about, please, add them in. I'll reach out, I'll answer them and respond to them. I'm going to share not just about an overview about borrowings and loans, by the way. I'll share some tips, got some resources to share with you. That magic word free, which you probably don't often hear from an accountant, but I'm going to share some free resources for you to do some of the heavy lifting when it comes to the numbers. Okay, without further ado, folks, let's crack on with the broadcast. So the theme of the broadcast, and I'm going to disappear from the screen in a few moments. Again, if you've got comments or questions, fire them into the comments box. I'll pick them up and I'll respond to them accordingly. So it's borrowing money for your business, the when should you do it, if at all, why you should do that. Now that obviously might sound a ridiculous statement, and how should you go about it? So let us move forward. I'm going to take myself out of the screen so we don't get distracted. So I'm going to be covering within the context of loans, and loans represent a commitment. So we're not talking about overdrafts, even though that's a form of borrowing. We're not talking about supplier credits, where we negotiate times with our suppliers before we pay their bills. We're not talking about the idea of customers, where we offer them credit terms. We're talking about loans, which represents more of a commitment. If we think in terms of borrowing on our properties, to buy homes, to buy household contents, to buy things in our personal life, we may decide that loans may be the way forward to actually finance that particular purchase. And for me, it's about being crap, i.e., we're going to consider the cost involved in loans, risk, and everything in life has an element of risk attached to it. Attitude, and that's our own attitude as well as the attitude of the lender. And lastly, we're going to be talking about planning. For me, those are the four ingredients that we need to blend together to deal with this topic more effectively. Now, let's have a think about cost. Now, in the world of borrowing, in the world of loans, and the loan market is a much more complicated, sophisticated, and a competitive market, believe it or not, than it was compared to, say, 26 years ago when I started business from my back bedroom. But typically, with loan costs, it's broken down as follows. You've obviously got the cost involved in actually doing the loan application. And what you will find is that if you decide that you want to go to your bank, if it's what I call a conventional bank, one of the top four banks, the high street banks, if you want to apply to your online lender, then you've got the application process involved itself. Now, depending on how much you're looking to borrow and how you make that decision, I'm going to deal with towards the end of the broadcast. But once you've made a decision that you need to borrow some money, or you want to borrow some money, or you have to borrow some money, then you've got the time involved in either putting a loan application together. You've got the cost involved in actually making sure that you can keep up with the commitments. And typically on your loans, you're going to have two types fundamentally. You either have something called a repayment loan, and I'm going to draw the parallel with a house purchase. So if you want to buy a property, typically the two ways that you will finance that purchase of that property is you either you borrow the money from the mortgage company, from the loan provider, and let's say for argument's sake the house cost is a couple of £100,000, you borrow a couple of £100,000, and the lender will either say with you, I want you to pay that £200,000 back bit by bit over the next, say, 25 years. And the lender is there to make a profit from you. And their profit is represented typically in the interest that will be charged on that borrowing. So they'll work out whatever the interest is on that borrowing, they'll add it to the 200 grand, and each month that you make a repayment, you pay back some of the initial borrowing, which is what's called capital, and plus you pay an element of the interest as well. So over the next 25 years ago, assuming you don't change your loan, you will chip away at the amount you borrowed originally, and in 25 years time, very simplistically, you paid off the original debt and you've given the lender the profit that they've made from that transaction, i.e. the interest. Alternatively, you have what's called an interest-only loan, and in that same relationship, you'll say to the lender, and the lender says to you, okay, you can borrow the 250 grand, 200 grand, whatever it was, and we're only going to charge you interest on that borrowing. So each month, there's less cash leaving your business because all you're doing is paying the interest on the debt. At the end of that term, we're getting towards the end of the term, you've got to then find somehow the 200 grand to pay the lender back what you've borrowed on top. So initially, in the short term, it's going to be interest only, so that's less pressure on the cash flow. But eventually, you still have to find that cash to pay the lender back. This type of loan, by the way, that sort of choice is typical for property investors. So clients of mine who have buy-to-lets, in the main, they will get buy-to-lets, and it will typically be an interest-only loan. I'm not saying it's the only type of loan, but that tends to be more commonly accepted. Interest is obviously a lower cash commitment. They tend to keep more of the rental cost, the rental income that's being generated, and therefore that's what we need to consider. Now, if you want to work out the monies involved, obviously you can apply to the lender. They'll give you the samples, or you can hop on to our website, check under the resources section where we've got a whole menu of online calculators. There's a loan calculator in there. You can just tap in a few numbers, press the button, and it will show you how much you've got to pay back, whether it's interest only, whether it's repayment. So tap in the interest rate, type in how long the loan is for, how much you're borrowing, and hey presto, it will give you that. As an added extra, by the way, this topic was inspired by bounce back loans because it's coming up for repayment soon, 12 months after they were mostly taken out. And it will also factor in the cost of your bounce back loan if you decide to keep to the bank's commitment and just pay it over the next X number of years, or you are looking in terms of paying it back early. So you can see the consequence there. So costs of preparation, cost of the application, costs in terms of repayments, and then again, when you've got a commitment, a loan to be paid back, think about the cost, the cash that comes back at the end of that term. Now, can I just say as a health warning here, loans typically are either reactive, so circumstances such that suddenly, maybe your business is facing a real big challenge, customer demand has gone down, you've got a big commitment here to pay off existing debt, you decide to refinance, and that's what I call perhaps a reactive situation. Or you've got a proactive situation. So in my early days of my business life, 26 years ago, when I first started from my back bedroom, I just started off. I was juggling up lots of different jobs just to keep the cash flow going. I borrowed money, so I had a bit of a cushion. I didn't necessarily borrow very wisely, by the way. I probably took out loans that I didn't need to, and I was being more reactive in the early stages. But, borrowing money for lots of businesses is a very positive thing. Once they figure out what they will need in terms of which direction their business is going, if it's pivoting, if it's expanding, it's growing, that money is going to come from somewhere, and loans can be a very positive source of that finance. So again, think about the cost, think about the cost to you, think about the cost of alternative fundings, whether you issue shares out to somebody, whether you borrow that money from elsewhere. So cost is the financial, it's the repayment, and obviously, typically what you'll find is one last influencing factor is the more security that you can offer a lender, the more stable your business is. Then if your loan is secured somehow, and the risk is less to the lender, the loan is cheaper. So again, lots of different types, and high street banks aren't the only show in town. Another attribute is risk. Now, in risk, what you've got to bear in mind here, there's lots of risk. There's the risk to the lender of them providing funds to you for your business growth, to keep the wheels turning, to perhaps refinance. You might have debt that's quite expensive. You want to make it cheaper. You've got to think in terms of your own well-being, in terms of, we're going to deal with that in the attitude side later on. So the lender's going to look at you and decide what sort of level of risk do they have for their money being paid back. What type of business are you? So as a crude rule of thumb, when lenders figure out how much the repayments are going to be, they will take a number of variables into account. Just like when you insure your car, your insurance company will take into account a number of variables like your age, the type of car you're driving, how many miles you're going to be driving, and they determine the risk involved, and that helps figure out the insurance cost. Whether you've had accidents, your driving record, all those factors contribute to a risk score for the insurance company, and it's the same with lending. They will take on board a number of variables about your business, figure out how much risk there is involved to them for defaults, them not getting paid, and they will work out what the interest rate they're going to charge you, which fundamentally is their profit. You've also got to look at it in terms of a loan represents a fixed commitment. So every single month, you have to pay back to the lender a determined amount based on how much you're borrowing, over how many years, what risk you represent to them, whether the loan is secured. If it all goes belly up, you've got something to give them in exchange. If it's unsecured, which is a riskier type of debt, then all that represents a commitment. And those commitments, by the way, represent fixed costs to your business. And those fixed costs are commitments that have to be met irrespective of how profitable your business is. So if your business is static, if you're looking to actually grow your business, but you've got to invest, buy machinery, engage more freelancers, more staff, buy more materials, do more prototype testing, more market research, enhance your capacity, recruit your team until those things start to generate value, then there is a risk that in that interim period, you've got to find that money to service that debt. Doesn't mean it's a bad thing. The whole thing about risk and fixed costs are, yes, they represent a commitment, but if your business is moving forward, if you're optimistic, you've got market concepts tested, and you're confident that the direction you're taking your business is positive, if you're confident that that investment in capacity, that's what loans fundamentally are doing there in that proactive things. They're giving you the funding in order to upscale, to grow, to move forward, freeing you up. That will give you greater opportunities there. That's what the loans are there to do. Then what you'll find is you'll actually make more profits by borrowing, believe it or not. I know it sounds quite perverse, but if you imagine a member of staff, if you take on more business, you're not necessarily going to pay that staff member more money in proportion. Therefore, you make more profit as a result. So effectively, the risk isn't always a negative thing, but there is a risk itself. As a plug, if you check onto the website, check out the resources section, you will find a risk calculator. It's called gearing, which is a very posh word for measuring the level of risk that you have in your business due to costs, particularly fixed costs. And you can use the sliders to figure out the extra risk that you take, how much money you need to generate in order to stay afloat and make the profit that you wish to. So what's your risk appetite? What does your business look like? And again, factor that into account. Attitude. Now, here, I think historically, COVID aside, pandemic aside, the general attitude to debt has changed quite a lot in the UK and around the world to debt and to borrowing money. Many people that I come across are quite wary on taking off debt, and I can fully understand that. And it could be because they have that fear and anxiety. If things don't quite work out, what are we going to do? They see that as an additional strain on their own well-being levels. That level of uncertainty, that level of having to do something, worrying about what's the impact on my personal assets, life outside of that. And debt represents a bit of a strangulation of the mind. And there's a reluctance to take on debt because debt is seen as a bad word. And I fully understand that. And I think if you just take on debt, that you're reacting to a situation, i.e. you've not actually figured out what's going on in your business. You haven't got a good handle. You don't know what's occurring. You haven't got a good control of your numbers. You're literally reacting on it. You're working so much in your business, reacting day to day. You don't have a route map, and you're borrowing just to service short-term debt and all the rest of it. Then it's going to create a lot of anxiety, understandably. Now, I would never say to somebody, you must never borrow money, or you should always borrow money. A lot of it depends on your circumstances and your decisions. But in positive times, in good things, debt can be a very positive thing. It has a positive impact on profitability. It enables you to do the things that you want to do. So many businesses I see, they get to that tricky part in their business life where they've gone from effectively single solopreneur. Their business has grown, they're taking on more business, but they're now at that crossroads of thinking, actually, there are great opportunities out there for me to do. There's more people that want me to do something for them. There's only me and maybe one other team member. I need to recruit more staff. I need to do X, Y, and Z in order to take my business forward, have a more sustainable business, have a growing business, be more successful. All those things that will only happen once you get funding in to support the plan, to support the roadmap. And in that case, doing the debt proactively can be a really positive thing to get you where you are. Any business of any size that we all recognize as household names, institutions, have got to where they've got by getting finance either from investors or typically from borrowing that money. A very good thing about debt, by the way, to bear in mind is the control. So if it's important in your own company that you want to maintain control of the direction, the decision making, and all the rest of it, well, effectively, borrowing money means that you maintain that equity, maintain that control in your business. Obviously, if you're taking on debt haphazardly, you've got no real structured way of looking at it, then the control becomes you to the lender. So really, you've got to re-examine your own mindsets, your attitudes to debt. What are they? How are they formed? Typically, they tend to be either shaped by the unknown, our own sort of money mindsets that we've inherited, that we've got from children, from growing up, that divorcing our disconnect from money itself. Attitude changes everything. So look at it as a resource that you can access to help your business move forward, which is why I would look at it. And sometimes, debt can be that thing that powers your business forward, and sometimes it can be that thing that strangulates your business. Your risk appetite, you may be somebody who doesn't want to step outside their comfort zone, somebody who doesn't want to take on that element of risk. And let me tell you, folks, business is risky. You cannot avoid it. Everything we do in our businesses, doing nothing at all, is risky. Doing nothing at all means our business may go backwards. It means we may lose out. We may lose customers. We may not have the ability to serve them. As our businesses get busier and we don't have the capacity to cope with them, then that's going to impact on our customer service, our customer delivery, and therefore we will find that a very difficult thing to move forward on. Now, the last thing is about planning. All of this pieces together, and I would never recommend to somebody to take on debt unless you've done a cash flow. Now, I do a lot of what I call cash flow planning with clients effectively, and what we do is we look at their financial future, their business future. We're looking at what their roadmap is for the 12 months to 3 years ahead. We're looking in terms of where they want to take their business, no numbers at this stage, and we generate a cash flow. And once we know what that business ambition is, once we know what the business aspirations are, once we know where they want to take the business, their sense of purpose, their journey, their destination, then a cash flow, a financial plan can be produced to support that vision. That is the decision then, once we know what the cash challenges are or opportunities, as to whether money should be borrowed or not. So my personal view would be, it's foolish to go ahead and borrow money unless you've at least done a cash flow. Typically, as a minimum, do it for 12 months. Ideally, look ahead for 3 years. Obviously, the further in the future that you go, you may say there's less detail, but it's not about detail, it's about thought process. And then we can figure out what the shortfalls are in order for us to make that growth spurt, in order for us to maintain that capacity, increase it, in order for us to take the business into areas that we wish to. What's the cash that we need to make it work? Cash for me, fundamentally, if you do not have cash, your business will come to a standstill and eventually it will go under. It is very feasible and possible and happens that you may not make profits in early stages of a business pivot, a startup, a growth spurt. If anything, there may be more cash going out. If you don't make profits, that's cool in one respect. But if you don't have cash or access to it, say goodnight, you will not survive. Now, if you're thinking about what's all this cash flow stuff, by all means, please check out my website, look under the resources section, check the news section, check the podcast, and there's also check out the events page. And I'm doing a webinar session on how to take control of your cash flow on the 5th of May. Check it out there. I'd love to see you on that session, and we're going to cover the mechanics and the construction of a cash flow. More of that later on. So fundamentally, if you are deciding to borrow, or that's certainly an option, or you're looking to repay it, whatever, you must do a cash flow. I would say whatever your circumstance, if you don't have a business cash flow, then you are really reducing the positive impact you can make to your life. For me, a cash flow well constructed of the way that you go through the construction process relieves the anxiety, minimizes the stress, puts you more in control of what you're doing in your business, and then you've got a greater clarity and relief about what lies ahead. It's that fear of the unknown, to me, that really doesn't bode well for our well-being and running our business. So do a cash flow, and that's a basic starter. Okay, let's come back to that one in a moment. Let's come back. Let's go there. So folks, let's just round up what we said here. Loans, if you look at them, they have their place, and it's all about being crap with them. So it's about thinking about the cost, thinking about the risk that's involved, what your risk appetite is, the risk that you're taking on, and the risk that the lender is taking on. Remember, it's a two-way relationship. The lender is assessing the risk to them of not getting their money back, your ability to service that debt. We're talking about your own attitude to debt, how you handle it, how you manage it. If you're chaotic, if you don't trust yourself, if you're not quite sure what's going on, then you minimize that. You improve your well-being, you improve your stress levels, you effectively reduce your anxiety, you put yourself more in control, you do a cash flow. I know it sounds simple, but simplistic answers sometimes gives us the best solutions in life. A couple of things in terms about if you're thinking about loans. Now, I'm not a loan lender. I don't know if that makes sense. I don't provide loans. I merely give advice to those who are looking to do that and see that as part of a business cycle. Loans follow purpose. So think about your business purpose, think about your business destination, think about what you want to achieve. If you're looking to achieve growth, if you're looking to develop a new product, a new concept, and you want to make it happen, loans could be a real positive way to actually make it happen. High street banks, they're great. About 35% of loan applications from SMEs tend to fail. They do put you through a number of hoops because they are more risk averse these days as opposed to risk bullish. I know we've got the bounce back loans. Obviously that's stopped now. You can't apply for those anymore. But loans are, in relative terms, are relatively inexpensive. I'm not saying they don't have a cost. They do have a cost. So, you know, check out a variety of loan providers from, I'm not going to mention any particular names. I'll mention them in the comments. But you've got online loan providers. You've got a fintech, as they call it. You've got peer platforms that also lend money. You've got your conventional bank. So the source and where you go from is obviously part of that decision-making process. But be prepared before you go and actually apply for those loans. So folks, hope you got some value out of this. If you did, give me some feedback, give me some comments. I'd love it if you could share that. Check out the calculators on the website, the resources. Check out some news if you want to know a bit more about the world of borrowing, funding, getting money into your business, growing your business cash flows. Then check it all out. And check out the events page as well, I would recommend, in terms of the upcoming seminar. I don't know if seminar is the right word for it, or webinar or session about how to take control of your cash flow. Failing that, hope your first week of lockdown's gone pretty well. Carry on, have a fantastic week ahead, and I'll see you guys then. So what we do next is what we haven't had. Let's play out with a bit of music.